All right, here we are, episode 129 of Man and Machine. Today, we are going to be talking about Tyson Foods feeding the world. We are going to be covering a bunch of other stuff. But before we get into the agenda, Mark, how was your weekend? You'll notice Dillon's not here. We'll get into that in a second. But Mark, how was your weekend?
It was good. It was a nice weekend out here in Connecticut. So got outside. I don't know, not much to report. What about you?
Yeah, I was backstage we were talking and it's finally starting to feel like summer, which is great. I got a nice round of golfing on Friday. Was really happy about that because it was pouring. It was pouring in the morning into the early afternoon, but it did clear up really nicely and the course held up well. So happy to get out there. And then over the weekend, for all those baseball fans, big Yankees Mets matchup over the weekend. Yankees did take the series 2-1 with the game last night. So fun weekend overall. We got Doug here. Doug, happy new week to you as well. Let's get some music going. And like I said, you'll probably notice Dillon is not here. So we're gonna have to, Mark, fill in all of the words that Dillon normally says. Between you and I. So
Big shoes to fill there.
let's get some music going and then let's get into it. Today we're going to be talking about, like I said, Tyson Foods. That is our stocks in real life. We are going to be talking about the King Condor bot still. Last week we talked about the time of entry during the day. So the King Condor strategy, again, we'll go over it exactly what that is again. Looks like I lost Mark, but we'll be all right. We'll talk about the King Condor strategy. Today we are going to be reviewing the width of the wings of the strategy. So there's two spreads in an Iron Condor. There's the call spread and the put spread. And we're going to be looking at the width of the wings and how that affects the overall trade. But real quick, just a little recap from PeakBot picks last week. PeakBot picks. Thomas was one for 3. I was 1 for 2. Dillon did not make picks. Dillon is out. He's down in Florida on a vacation right now. So he'll be back in action this coming week and participating in picks next week. So I think that means I won. I'll take the win for the week on that. And all right, Mark, let's get into it. I'm going to bring up the screen here. We're going to talk about, like I said, Tyson Foods. Now, my only real experience with Tyson Foods is probably their frozen chicken and just heating up their chicken strips. And that was a popular item for me growing up. Mark, what's your experience with Tyson Foods?
To be honest, very little. I had to do a little research before to see where this might fit into my life. But they are the largest, I believe, meat producer in the U.S. But what I didn't realize is that most of the food you're getting, if you're eating on the go fast food, that's Tyson behind that. They've got McDonald's, they've got a number of the big. They've got KFC, Taco Bell, Burger King, Wendy's. They're all over. They're behind, I should say, most of the food you're getting if you're getting fast food.
Yeah. I actually just looked it up too. They have Chick-fil-A as well, which is interesting to know. We got James in the house. Good morning, James. Yeah, they got Chick-fil-A, and it's funny. There's a Chick-fil-A, I don't know, probably 20 minutes from me that we rarely drive by, but for whatever reason, my wife and I drove by it, like, I'm not kidding you, like 6 times this weekend. And it wasn't as packed as normal. I don't know, Mark, if you keep pulse on Chick-fil-A at all, but I remember a couple of years ago I don't know, it felt like 4 years, there were just endless lines at Chick-fil-A. But driving by on a Saturday, it was during lunchtime. No line really. I wonder if the Chick-fil-A craze has ended.
Interesting. Yes, because there definitely was a Chick-fil-A craze moment. I remember when they opened in New York City, and it was like the biggest deal to get Chick-fil-A. Of course, they're not open on Sundays. But yeah, regular weekday lunch lines would be packed, and their food's good. I don't know if it's the be all end all of chicken sandwiches, but it's a good sandwich.
I really enjoyed it. I'll tell you what, though. I would go to the Chick-fil-A near Grand Central, and that one, they were official. They knew what they were doing, and they would get you in and out. They had to go through thousands of sandwiches every single day. It was just like clockwork. They knew what they were doing. They were a well-oiled machine there. So, Mark, did you mention what other brands Tyson owns?
They do have a couple other brands. Where'd that go? They are, I believe they're Jimmy Dean, Hillshire Farm, Ballpark. Good hot dog there.
Ballpark Franks.
So yeah, they've got deep roots out there.
They sure do. They sure do. Taco Bell uses Tyson Foods for their new crispy chicken nuggets item, which interesting to get nuggets at Taco Bell. But yeah, I mean, other than that, I don't really have much other Tyson Foods experience in my life. I'm gonna just head over to my Tradier account and see if I've ever traded ticker TSN. Looks like I have not. Mark, have you ever traded Tyson?
No, I had to pull it up actually, and it doesn't actually trade all that much. I think over the last year or so, it's been pretty consistently in that like 2,000 contracts a day range. So that's something. There's to the extent that you do have an axe with this, there's okay liquidity. We don't see weeklies, which is I suspect why it has not popped up in your history. We've only got the regular serial months, and it's funny. You look at an options chain like this, and it really like harkens to days gone past. Whereas like now, there's a strike and an expiration for every single thing you could want. Tyson's old school. It's got monthlies. It's got 250 strikes. All your strikes can fit on a single window without scrolling. So all that said, markets aren't terribly wide. We're a dime wide here, which is on the wider side compared to the ultra liquid stuff we're looking at. But I suspect you can get some fills in between here. There's decent open interest out there, and like I said, 2,000-3,000 a day isn't nothing. So
yeah, definitely doesn't meet the requirements for it to be on PeakBot bots, specifically the wheel or trend spread, because we are looking to make weekly premium there. It does look like they've been pretty steady for the past couple of years between, I'll call it $50 and $65, kind of bouncing back and forth in between. I wanted to take a look to see if there was a COVID impact, and I mean, it did dip down, but it did not increase way back up quickly. I was thinking with COVID, maybe more people were not going out to eat. Of course, they couldn't go out to eat. Maybe more people were buying Tyson chicken, but it doesn't necessarily look like that. But they did get a 100% swing, it does look like, from the low of COVID of like $43 all the way up to, in 2022, about $100. So that's a little over a 100 point swing there. And then it's kind of just been downhill and consolidation since then. It looks like they do pay out a dividend. What is that? 50 cents per share on a $56 stock. That's not terrible. Not too bad.
Decent div pair.
Yeah. So, Mark, if you had to trade Tyson, how would you trade it? Just based on what we see on the chart, what we saw in contract volume, dividends, all things in consideration.
When I look at this options chain, I see, it doesn't have the granularity that you'd look for to put on like some very precise spreads. Like you're not going to be able to put on the exact broken wing butterfly, multi-legged kind of spread that you might be able to in SPY at exactly your dimensions. So as I see liquidity go down, that generally makes me more inclined to do simpler and simpler trades. So if we have a lot of options, so to speak, a lot of choices on the strip, then you can do some more complicated positions. But here, kind of given the liquidity, given the number of strike selections, I'm erring on the side of a simple call and put spread could work. There's definitely credit and debit spreads, two-legged, put verticals, call verticals that could make sense. A dime wide on either side means you could be giving up to 20 cents in kind of theoretical value, like trading across that. So, you got to be careful fishing in the middle there and execute deftly. But this also works for overwrites. This also is going to work for simple put selling, simple call overwrites on underlying positions. There's enough depth and liquidity here that, you can get off some decent, simple buy rights or, put selling. Even a wheel trade could work in this.
Yeah. How would you feel about a condor, right? Because it looks like over the last, year, we've been trading between $55 and $65. Maybe putting a condor up at let's say the 50 strike, and let's call it the 65 strike for now, since we're at $55. What are your thoughts there? Because I think that's probably what I would trade right now, at least.
So right now, the closest expiration is June, which we've got 32 days. I see implied vol in the 19 range. The problem is we're trading at 55. The 52 half strike is 30-cent bid, and the 50 put is 20-cent offered. So you've got a decently wide market there. Maybe you're collecting at the midpoint, fair value, it's saying 17.5 cents. On a 250 strike, that's I don't know that's enough premium to get me in there.
No.
And on the upside, if I sell the 57 half to buy the 60, all in, if I'm really lucky, I get 60 cents for this whole condor. Maybe if I smash the bid, I'm collecting 45 cents. It's a little light on 250 for me.
I totally agree. Now looking at the numbers here, looking at this June expiration, got loaded up in Tradier. I actually went to the 65 strike. I'm going to go down to the 60, 62 and a half. And then
62 and a half is no bid in June. So the problem is a little tough. Honestly, 60 cents is a low vol midpoint anyway, right? We know this is only a 19 vol stock. So, but to give up, potentially up to a quarter of your premium just to get it executed crossing the spread, that's kind of one of the dicey things about these wider, thinner, low vol names. So, just on entry, you're giving up potentially a quarter if you're fully crossing the spread. And I think Doug actually has got a great point here along those lines, that it's going to cost more to adjust and exit too. Closing this trade, you're going to end up lifting some offers. And to the extent that you need to roll one of those legs, again, really a couple closing or rolling trades just destroys your whole edge in this. So I'd like to see a little tighter markets, a little more strike granularity before I started getting cute with multi-legs here.
Yep. Yes, I mean, we say it all the time. Sometimes the best trade is no trade. And I think for Tyson Foods, for me at least, the best trade here is going to be no trade. I don't think I'll be trading Tyson anytime soon. But hey, if you're a fan of their fried chicken and all their other brands, maybe you sell a $55 put and maybe you wait to get assigned. And maybe if you do get assigned those shares, maybe you do collect, it looks like 50 cents every quarter. Is that consistent? Yeah, it looks pretty consistent, 49 cents.
And with a low vol, high dividend paying name like this, you can sell out those 57 calls, that are up $1.50 or whatever from where we are now. Collect 50 cents on that. That's not a terrible trade to overwrite. I actually think single leg trades on this, there's liquidity there. What'll get you is the spreads.
Yep. Yeah, that's for sure. Mark, any guess on IPO year for Tyson?
This feels like a 50s staple. I'm gonna guess they're like a 1955 IPO.
1955. It was March 17th, 1980 is when they IPO. Wow. So I would assume the business started before that. Let's see when they.
So I've got my Wikipedia up here. Maybe it has the IPO, but they were 35 when they were founded.
Okay, yeah, I see that too. 1935 in Springdale, Arkansas. Very cool. Every Google search I'm doing, there's always in the people ask section, does Chick-fil-A use Tyson chicken?
Huh.
Like every single Tyson Foods query I put in here. All right, cool. Anything else on Tyson Foods?
I did just notice their logo, the classic logo, apparently they discontinued in 2017. So that red and yellow Tyson logo that you totally picture on stamped on the chicken, they discontinued that for a boring, modern blue and white Tyson as of 2017.
Oh, look at, hold on, I'm gonna pull it up on screen. Check this out. This is their logo evolution. So they started with that yellow and red color back in 1978, leading up to their IPO. And is this the logo you were talking about, Mark? This one from 2017 to 2024?
Yeah. Oh, they did switch back. Okay.
It looks like it. Recently, though, last year.
Very good. Yeah. Oh no, that one that they basically had, slight modifications from 78 to 2017. That's what I picture as the Tyson that they're back to now.
Yep, Sam. And it looks like they put foods in the logo now as well.
I believe I saw they were experimenting with some plant-based stuff, so they're probably trying to get past just being a chicken company.
Yeah, probably. All right, cool. I think that about wraps it up for Tyson Foods. Unless, Mark, you have any other comments. If not, we can get into the bot shop.
No, I think the most important thing I think we learned about Tyson as far as trading is you've got to adapt your strategies to the liquidity that's in the marketplace. And while it might not look like a great condor trade, there's plenty of other interesting things you could do to the extent that you have an opinion on this. So I wouldn't let, thin liquidity immediately spook you off. You can still find a trade that will fit your thesis of it.
Yeah, for sure. Okay, well, let's get into the bot shop. This is going to be an interesting conversation today, and we're gonna find out why in just a minute. But in the bot shop, we're covering over several weeks our King Condor strategy. After we're done with the King Condor strategy, we'll work our way into the next bot that PeakBot uses with Harvested. You know what, Mark? We got to get your logo on here too, along with Tradier. I'll get that added, but. We want to get to understand the King Condor strategy a bit better. It is a very popular strategy right now. It is a 1DTE iron condor that has very specific parameters that allow for trades. So we will, again, review the base of the King Condor, how it's currently out in the market right now. We're going to look at the width of the spread and how that can impact. And Mark will give us a bit of an overview on how the width of a spread can change the entire dynamics of a trade. We're going to talk about how if we tightened or widened the width of the spread of this iron condor strategy, how that would impact the overall results, and then conclude on what we think is best or what we eventually ultimately landed on for the King Condor strategy. So again, just to review, the King Condor strategy is a 1DTE iron condor, opens up in the afternoon, and we learned that last week. It opens at 3:15. So it is an afternoon opener. It trades, it sells the 20 delta, and then we'll talk about the width of the spread today. Won't give that away, but it does have a stop loss on both sides, on both legs of the condor. It is a trailing stop that triggers after a certain gain has been achieved. And the win, a win on this is just letting those contracts expire worthless. We don't want to necessarily pay any money back to close those spreads, even if it's only 5 cents, because there are additional fees associated with closing down SPX contracts. So we want to keep as much money in our pocket as we can, and doing back testing on letting that expiration happen versus taking profit at 5 or 10 or 20 cents. We'll cover that in another week, but it was more advantageous for us to just let those legs expire worthless. And Doug, to answer your question real quick, does the stop close the whole IC or just the challenge leg? It's just the challenged leg. And there were 2 instances in the last 3 years where the bot did take, or the strategy did take a loss on both sides because of that. However, wasn't enough to influence the change. So that's the King Condor base. If we look at the high level statistics here, we've got, we've started trading with $10,000 of capital during the 3-year test period. Total P&L, so total profit, was over 25,000. That's a compound annual growth rate of over 50%. Small drawdown, and that's because we're using $10,000 to trade. I'll give it away now. A $10 wide wings, right? So you really only need $1,000. So we're able to keep drawdown low by making sure we have enough cash set aside to handle these blows, and then let those wins compound on each other. Overall win rate of 77.7%, and that's per leg. When you combine the legs, in today's, it's more like a 56% win rate. And then the average winner is $150 per leg. Average losers $370 per leg. Again, we've got to net those out every day. Winners, you have 2 of those $150. Losers, you have that losing amount minus the $150. So that's the baseline King Condor strategy. Now, we're going to take a look at what are the pros and cons of a $5 wide wing, $10 wide wing, and a $20 wide wing. So, Mark, I'll hand it over to you to cover this breakdown, starting with the pros and cons of the $5 wide wings.
Yeah, so, really, I think the big axe here when we talk about the width of the spread is that is the ultimate stop loss on any trade. And that's, getting down to some real options fundamentals. The width of the spread is going to determine your absolute max loss, your absolute exposure in there. Obviously we try to use stop losses to tighten that. And I think that's an important part of this trade by putting on, collecting bigger premiums, but stopping out before that spread might stop us out. But at the end of the day, that spread is going to be defining what your maximum risk is, and ultimately what the premium you're going to collect for exposing yourself to that maximum risk. So options 101, the most you can lose in any trade, in any credit trade, is the width of the spread minus the premium collected. So if you collect $1 on a $5 wide, you can lose up to $4. $2 on a 20 wide, you can lose 18. But obviously you're collecting 2 versus 1. So, I think that's really the fundamental question we're trying to balance here when we look at various different spread widths. Along the lines of those max losses, ultimately the capital that your broker is going to require you to put up is going to be a function of the width of those markets. They don't know that you have a stop loss out there necessarily, or they don't know where you're going to get filled. So capital is always going to depend on that spread width. You're going to need $500 in the $5 wide, $1,000 in the 10, $2,000 in the 20s. So to the extent that you have tighter market widths in your spread, or tighter widths of your spread, you're going to need lower capital requirements. So lower capital requirements can also translate into a higher return on risk. So, in that same example, if I only collect $2 on the $20 wide, that is a lower return on capital than the $1 on the $5 wide. But of course, $18 is a much bigger loser than a $4. So we're balancing percentages here. We're balancing absolute risk. And then we're also trying to incorporate, obviously, the stop loss with the King Condor. With a tighter width, you're going to see faster movement. So we, $5 in SPX, especially these days, that can blip very quickly. So we're going to see those spreads jump much faster. Whereas on the wider ones, they're going to move a little bit slower. Wider, you're buying in at a lower delta. So you are, extending your risk range there. And assuming that the further and further that out that gets, the lower percent chance it's really going to test all the way. But a big part about trading condors is managing that area in between, which is, again, I'll point back to the stop loss here. So I think at the end of the day, we're balancing capital usage, risk premium capture, and absolute risk here as we look at the various widths across these different condors.
Yep, definitely. And the one point you made, Mark, about the width of the spread being the ultimate stop loss, when we're developing strategies, that's taken into consideration heavily, right? Because trading algorithms, like every other piece of technology, there's a lot of third-party dependencies, and if any of those third-party dependencies, and it happens for companies like ours all the way up to technology companies like Apple, for example, there's always going to be blips in technology, and I like to know that my ultimate stop loss is something palatable, and that'll become more clear in the conversation we're about to have. Let's get into some comparisons here to see how this strategy would have done with a 5 wide versus a 10 wide. And just for reference, we did land on the $10 wide wings for the King Condor strategy. So that's going to be the baseline that we're comparing to. Here's the first comparison. So $10 wide wings to $5 wide wings. We can see the $5 wide wings have a much choppier P&L. The actual P&L is a lot less. The CAGR is a lot less. The drawdown's a lot higher. So it really, really changes the dynamics of the trade here. And Mark, not to have you rehash everything you just said, but like, what do you think the reasons for this trade being so different compared to the $10 wide wings? Like, what's driving that difference?
I think it's really comes down to, I mean, like if we were going to think about this on a pure theoretical basis, we'd be thinking about these widths, these wings, the width of the spread there as a percentage of the stock. And I think as you get to be a lower and lower percentage of the stock, SPX can clip up $5 in a half a second. So I think that creates much jerkier kind of behavior of that spread value. And I think that'll end up triggering stop losses more frequently. That'll end up triggering max losses. Whereas I think on the wider wings, you have a little bit more room to manage these. And you can kind of land more on that stop loss management rather than that max loss management.
Mm-hmm. Yeah. That makes a lot of sense. If we look at the numbers here, it looks like less trades were taken, which would indicate that there was actually less stop outs on this particular strategy. There's a lot of factors. The one key metric I'm looking at is average dollars per trade, right? Because you're going to win, you're going to lose, but what does that average out to net per trade? $6 for the 5 wide and $38 for the 10 wide. So I'm choosing the 10 wide every single time. Doug has a interesting point. Your commission exchange fees always drove to a $10 wide spread, assuming that's because you're going to earn more premium on that, and that's going to offset the cost to trade. SPX is pretty expensive to trade if you're only trying to pick up a few cents on each trade, right? The commissions and exchange fees to get in and out of like a Condor on SPX, you're paying close to $10 to do that, which is not fun. Not fun to pay that.
That's why SIBO stock is trading at 222.
That's right. So here's where the conversation gets interesting, because like I said, we chose the $10 wide wings for the King Condor strategy. But when we look at it compared to the $20 wides, check this out, Mark. So $10 wide, our P&L is 25.6K, 53% CAGR, 6.7% max drawdown. Now the 20 wide wings, it's 38.3% profit. So that's like $13,000 more in profit, 70% CAGR, and you're only giving up an extra percentage in max drawdown there. Average per trade is $51, and that equity curve looks pretty nice. Now, I can tell that the stops have hit a lot more on this trade, because if you look at the number of trades, 678 for the $10 wide, and then 753 for the $20 wide. Again, that indicates a lot more stop hits. And then the overall win rate, 77.7 compared to 66.8. So it looks like, from a returns perspective, the $20 wide wings are the way to go. I know my reasoning for why we chose the $10 wide wings for the King Condor strategy. But Mark, any opinions on or thoughts on why we would favor the $10 wide versus the $20 wide in this case?
To me, I am a little bit of a paranoiac, and I always think about the ultimate stop loss of the spread width. And I think that, no matter how good technology gets, or, there's always slippage in markets, there's always whiffs, there's always, the reasons why you might not execute on your stop loss where you think you're going to. So to me, that extra premium that you collect on the $20 wide is not really worth the, I think, the amount of increased risk you're taking. And I think markets, especially in the short term, are only going to get jerkier. I think we're getting more efficient, but I think we're seeing a lot of intraday blips, as algos speed run each other, and that's going to land you more often in that max loss beyond your stop loss. So I prefer to keep that a little tighter personally.
Yeah, and I'll tell you, for PeakBot's purposes, we're providing trading bots to retail traders, and retail traders, again, this is unique that we're diving into all the specifics of this bot. But a lot of times retail traders, when they're using a trading bot, they don't get all of the details behind it. So they're kind of just stuck with the high level numbers of, like, what's the win rate, what's the average win, what's the average loss. Everybody wants to know, how much is this going to make me? How quickly is this going to make me that? And the $10 wide had a good balance of win rate, which is important to us, right? If people are paying a subscription fee to use a trading bot, they're paying to win. And on the $20 wide, the win rate just wasn't high enough to justify putting that out to market, because, again, people expect to win, people want to win, and the results on the $10 wide are still phenomenal. Of course, this is a back test, and we do include slippage, we do include commission and exchange fees in the back tests. But at the end of the day, it is just a back test. When you trade this in reality, things could look a lot different. And like you said, Mark, that $10 wide absolute loss just felt a lot safer, especially for people that are using this bot and just kind of set it up and forget about it, and they don't think twice about it. They never check their accounts. There's only so much that could go wrong. Whereas the $20 wide spread, I mean, you can see here the max loser on that was, what's going on here? Max loser here was about $1,549. So imagine that you just signed up for this bot, and the next day, bam, you get slapped with a $1,500 loser. Like, that's not fun. That takes a little while to recover from. Whereas the max loss on the $10 wide is only a little under $800, so about half. That's much more palatable, and you make that up in 3 winning King Condor trades. So, to conclude, I mean, those are all the reasons why we chose the $10 wide wings. More balance. There's more premium than the $5 wide, less risk than the $20 wide, and I'd say that's about that. This strategy has been crushing it over the past couple months. Mark, you've been using this strategy for your clients, right?
Yeah, I was actually going to correct you there slightly, that it's not just retail traders that are using this. Yeah. It's also the advisory clients of Harvested Financial. And I think what I like about the King Condor is, I've said a number of times, the whole risk management, it's the selectivity about getting in, but it's also about continuing to tweak it, right? that we're looking at these results and how they evolve over time, and constantly tuning the parameters, because there's no such thing as a persistent edge out there. So as the markets adapt, like spread width, I think is one of the big variables that we're adjusting and reviewing, I should say, and saying, is this the right target for us? Are we collecting the right amount of premium relative to the risk, et cetera?
Yep. So Mark, you mentioned it. I'm going to bring it up on screen here, and it's floating down on the bottom of the screen. If you are interested in trading bots, but you don't know if you want to manage them yourself or know what stocks to pick, well, you can have Mark and his team manage your account and your bots for you. You can go to peakbot.com/harvested-financial. That'll bring you to this page. You'll learn all about why you would want to automate, learn a little bit more about Mark and his fantastic career to date, see why traders trust PeakBot's automations, why they trust our technology. We're doing it the right way. And then we have some frequently asked questions. You got a fees slider here, so you could figure out, hey, if I'm coming in with just $25,000, and the accounts could open for as low as $10,000. Now that's something unheard of, getting a financial advisor on your side for just $10,000. That is new to the industry. And with the expansion of bots, that's going to become the norm, I believe. So we are one of the first to do it that way. So figure out how much this can cost you, and then go ahead and fill out this form below. You're going to get an email sent out to you with more details on how to get set up. And you could be trading as soon as this week. Or I should say, Mark could be trading for you as soon as this week, using his knowledge and expertise and using PeakBot's bots. It is the perfect blend of man and machine.
Yes, sir. We started a client application on Friday morning, and they will be trading tomorrow. So it's
there you go.
It's that quick.
That's awesome. All right, so I guess some thoughts to wrap it up. Doug says 0 or 1 DT thing is new. Always did 30-day iron condors. Yeah, I'm a fan of the shorter stuff. Not so much a fan of the longer stuff, although there's more time to adjust. But yeah, there's more stress involved, I think, in my opinion, at least.
The way I think about condors over time is, as you're getting shorter and shorter on that capture, I think the management tools are stop losses and finding the right sort of risk reward and flipping as many coins as you can. As you get longer and longer, particularly as you're looking at indices, there can be a decent amount of trend, even on a 30-day. And so you almost end up needing to hedge and adjust them quite a bit more. What that does mean, though, is I think as with any trade, right, the further out you go, there's going to be kind of more natural like cycles, and it's going to tend closer to kind of that true premium that might exist there. So if you're willing to do the hedging and adjusting, you have sort of a more stable profile with the longer dated. But I think what Ben likes, or at least what I like in the shorter dated, is being able to get a lot of what do I call it, at bats, and stepping up to the plate and get that right risk reward and just keep flipping the coin.
Yep, that's exactly right. Cool. All right, so let's quickly just go over some events happening this week, and then we will get out of here, get on with our day. So looking into today, we've had some Fed speeches this morning. We've got some Fed speeches this afternoon, some bill auctions. Nothing really speaking to me, at least. Tomorrow we got a bunch more Fed speeches. Going into Wednesday, just a big day today. We have the 20-year bond auction, which is grounds for Max's 0DTE orb bot to be turned off. We've got going into Thursday, again, just much more data. High importance as per TradingView is existing home sales. Got some more Fed speeches, some more auctions. And then Friday looks to be a relatively quiet day, and then really quiet afternoon after 1 p.m. Eastern. So nothing screaming at me saying, hey, Ben, shut off your bots this week. So we're going to let it ride and see how we do.
I think that's the right play. And, like on a day like today, right, where futures are opening down 1%, we probably won't be trading in the King today. Just seeing what the overnight action does. That's a perfect indicator of, hey, we're down 1%. Obviously, there's the Moody's downgrade and the why behind it, but the bot's just looking at the signals and saying, this is a market that is probably going to be more choppy than average. So my risk reward shifts significantly when we're down 1% to open the day.
Yep, that's for sure. All right. Thank you, everybody, for tuning in. We will be back in action this Friday with our PeakBot picks. Dillon will be back. It'll be myself, Dillon, Thomas. That'll be 11:55 a.m. Eastern this Friday. Make sure you tune into that. And we will be back here next Monday, 8:30 a.m. Eastern for Man and Machine, myself, Dillon, and Mark. So have a great week, everybody. We will see you on Friday. Most importantly, we will see you at the peak. Take care.
Happy trading, everyone.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.